Hey everyone, and welcome to This Explainer. Today, I am absolutely pumped to share a real property spotlight with you. We're going to completely unpack a brand new construction investment opportunity situated right in the heart of one of Indianapolis's most rapidly evolving urban hubs. For those of you out there looking for a turnkey, totally hands-off asset that actually makes sense on paper, well, you're going to want to pay close attention. We aren't just looking at a house today, we're looking at a highly efficient turnkey investment vehicle.
Okay, let's dive into this structured macro to micro journey. 1, the Bates-Hendricks boom. 2, historic versus new construction. 3, spotlight on 17 West Arizona. 4, the financial breakdown. And 5, long-term wealth protection.
Section 1. The Bates-Hendricks boom. Let's understand the macro context, because the neighborhood you buy in is just as critical as your monthly cash flow. So Bates-Hendricks is riding a massive wave of momentum right now, and there are a few huge reasons why. First off, proximity. It is right next to downtown Indianapolis, meaning super short commutes, but it still maintains this distinct, real neighborhood feel. Plus, it's benefiting massively from spillover demand. Right next door is Fountain Square, one of the city's coolest cultural districts. As Fountain Square got more expensive, folks naturally spilled over into Bates-Hendricks, bringing a huge surge of young professionals and downtown workers. When you pair that demographic shift with evolving infrastructure like brand new bike lanes, you get a neighborhood rapidly transitioning into a top-tier competitive market. It's literally the perfect storm for undeniably strong long-term tenant demand. Moving on to Section 2, historic versus new construction, and the pivot to urban infill. Now, take a look at the historic housing stock you usually see around Bates-Hendricks. We're talking late 1800s and early 1900s Victorian and craftsman-style homes. And look, there is absolutely no denying they have incredible architectural character. But let's be real for a second. From an investment standpoint, that charm is usually hiding some brutal, unpredictable maintenance costs. Century-old plumbing, outdated electrical, shifting foundations, these things will completely eat your profit margins. Honestly, nobody wants to spend their weekend fighting with a 100-year-old pipe.
Now, what's really interesting about this slide is how clearly it illustrates the pragmatic benefits of new construction. Historic homes give you that move-in-ready charm, sure, but they constantly demand modernization. On the flip side, new construction offers something absolutely crucial for out-of-state or passive investors: predictability. You get drastically lower repair costs, much higher energy efficiency, and the total peace of mind that comes with modern builder warranties. It's just a truly stress-free passive income strategy.
All right, Section 3, spotlight on 17 West Arizona. Time for the big reveal. Here it is, 17 West Arizona Street. This is the perfect turnkey solution that marries that crazy high-demand location with the rock-solid durability of a brand-new duplex build. This isn't just some speculative project. It's a meticulously designed asset built specifically with the investor in mind. Let's quickly rattle off the property specs so you know exactly what kind of highly leasable asset we're dealing with. It's a new construction duplex, meaning you have two separate income-producing units under one roof. Each side is 936 square feet with a super efficient 2-bedroom, 2-bathroom layout. And that bed-to-bath ratio, that is exactly what today's young professionals want, especially roommates who want their own private bathrooms. Section 4, the financial breakdown. Let's hit the numbers, because we all know hard, undeniable numbers are the lifeblood of real estate investing. $365,000. That's the purchase price for the entire property. In today's market, finding a brand new multi-unit asset this close to a major downtown for under $400K is just insanely competitive. It is a fantastic entry point into an appreciating market. And against that purchase price, we have $2,756. That's your projected total monthly rent. And this brilliantly illustrates the fantastic top-line revenue potential you're getting right out of the gate here. Let's walk through the clean math of the income versus the expenses to see what actually ends up in your pocket. We start with that gross monthly income of $2,756. Subtract your estimated monthly expenses, which sit at $2,436. Now, it's vital to note that this expense figure isn't just your mortgage. It comprehensively includes property taxes, insurance, an 8% property management fee, plus reserves for maintenance and vacancy. So even after fully accounting for literally all of those operational costs and your debt service, this asset generates an estimated $523 in true positive monthly cash flow. It pays for itself, pays the manager, and still puts cash in the bank. Section 5. Long-term wealth projection. Let's move to and see how this builds, looking way beyond just the monthly cash flow. First, check out this metric, an estimated cash-on-cash return of between 9.2% and 11.0%. This specifically matters for investors trying to scale their capital efficiently. Assuming a standard 25% down payment, your initial cash is working incredibly hard for you. Hitting near or above double-digit returns on a brand new, zero-headache property, that is huge. But hey, cash on cash is just one piece of the puzzle. There are three massive pillars of wealth generation at play over a projected 5-year hold. First, you've got $10,000 in collected cash flow. Second, an estimated $53,000 in natural property appreciation, thanks to all that neighborhood momentum we talked about. And third, $17,000 in principal paydown. Your tenants are effectively paying down the mortgage for you, buying you equity every single month. So, the crucial point is this number right here, $86,000. When you stack up your cash flow, that tenant-funded principal paydown, and the market appreciation, your estimated total equity growth in just 5 years is an astounding $86,000. That is exactly how real wealth is predictably manufactured. We've covered the neighborhood momentum, the undeniable perks of new construction, and the rock-solid financial metrics. From $523 in positive monthly cash flow to an estimated $86,000 in 5-year equity growth, the data paints a very clear picture. So I'll leave you with this provocative thought. With its perfect blend of location, low-maintenance durability, and high yield, is the brand new duplex at 17 West Arizona Street the next addition to your investment portfolio? Thanks for hanging out with me on this explainer, and happy investing.